Hello everyone, I am CA Prateek and you are watching the revision lecture for the Income from Other Sources chapter for CA Intermediate Income Tax Examinations. Okay, let's get straight into the video. In Income from Other Sources chapter, firstly let us discuss one of the most important sections, and that is section 56 to 10, which we sweetly call it as Taxation of Gift. However, in the Income Tax Act it is not mentioned that it is about gift. Okay, we are only calling it that. Now, when is this section applicable? This section is applicable when an assessee, it can be any assessee, okay, when the assessee receives any money or movable property or immovable property without or for inadequate consideration, then the person has to pay tax under section 56 to 10, okay, in the income from other sources head of income, okay. But be very careful, Kanna. See, this section applies only for gifts other than those covered under salary head of income and PGBP head of income. So if any person is getting a gift, okay, because of the employer-employee relationship, then that is covered under salary head. I think you remember that when I taught you about the perquisite calculation, we talked about gift and the limit was 5,000 rupees. Okay, if you don't remember, go and refer the salary chapter. Now let's come to PGBP. If in the course or furtherance of business, if a assessee receives any gift, then it is taxable under PGBP head of income. If any gift is not covered under salary or PGBP, it is taxable under 56 to 10. Okay. Now, first and foremost, let us discuss the exceptions of 56 to 10. So for whom and all this 56 to 10 will not apply. Okay. So for all the points that I am going to mention now onwards, okay, they need not pay any tax under 56 to 10. And for that I have given you a hint, and that is TRIM CD Lab 1023C 12AA Delhi, to remember all the 10 points. First point is what? T, and T stands for transaction not regarded as transfer, that is section 47. In capital gains chapter we studied section 47, where we studied so many transactions that are not regarded as transfer. That is, for those transactions capital gains will not apply, and in 56 to 10 also it is an exception. Hence for the transferor capital gain will not apply, and for the transferee, that is the person who is receiving the assets, 56 to 10 is not going to apply. Okay. Example, holding company to subsidiary, okay, demerge to resulting, then full or partial partition of HUF, gift, irrevocable trust, all those transactions. Okay. Now let's come to R. R stands for relative. If any gift is received from a relative, then the receiver need not pay any tax under 56 to 10. Who are the relatives, Kana? For an individual, relatives means spouse, okay, then brother or sister of the individual, brother or sister of the spouse, lineal ascendant, okay, that means parents, grandparents, great grandparents, etc. of the individual, lineal ascendant of the spouse, then lineal descendant of the individual, that is children, grandchildren, great grandchildren, etc., and lineal descendant of the spouse, obviously, because both will be same, and then brother or sister of either of the parent of the individual. That is, if I am the individual, then my father's brother will also be my relative. Okay. However, it does not apply to spouse. So my wife's father's brother is not my relative. You get my point? And then spouses of all the above that I have mentioned are the relatives of the individual. Let us see once again, very important. Relatives means whom? Number one, spouse, brother sister of individual, brother sister of spouse, lineal ascendant, lineal descendant of individual, lineal ascendant and lineal descendant of spouse, and then brother and sister of either of the parents of individual, and spouses of all the above are the relatives of individual. Okay. And for a HUF, the relative is the member of HUF. For a partnership firm, relative means partners. Okay. For a company, relatives means directors. For AOP, BOI, the relatives are the members, etc. Okay. Now, very important point, relationship does not mean vice versa. So if someone is my relative, it is not necessary that I am their relative. Okay. For example, my father's brother is my relative. okay, because it is covered in the relative definition. But for my father's brother, that is my uncle, I am not covered in their relative definition. Okay, I am whom? Their brother's son. Is brother's son included in relative definition? Answer is no. Hence, if I receive a gift from my father's brother, then that gift is exempted in my hands. Okay, it is not taxable under 56(2)(10). However, if I am giving them a gift, they have to very much pay the tax under 56(2)(10). Okay, so be very careful. So we discussed about relative. If any money or movable property or immovable property is received from a relative, then no need to pay tax under 56(2)(10). Next, I stands for inheritance or will. So if any property is received on inheritance or will, no need to tax under 56(2)(10). Next, on the occasion of marriage, not marriage anniversary. Okay, not marriage anniversary, it is on the occasion of marriage. So if on the occasion of marriage, if any gift is received, no need to tax that gift. Okay, next, on contemplation of death, that is almost while dying. Okay, that is while dying, if a person has transferred their property to someone else, okay, then the receiver need not pay any tax. This is called contemplation of death. I explained this to you in detail in the class. Now let's talk about local authority. If a local authority gives a gift to someone, then the receiver need not pay any tax under 56(2)(10). Next, B. Okay, B. B means benefit of individual. So if an individual, okay, creates a trust and that trust is solely meant for the benefit of the relative of the individual, then the amount given to the trust is exempt in the hands of the trust. You get my point? So if an individual is transferring any money or assets to a trust which is meant solely for the benefit of the relative of the individual, then the money received by the trust is not taxable under 56(2)(10). Next, 1023C. So for 1023C and 12AA, okay, whatever institution, college, okay, fund, trust, hospital, university, etc., covered under section 1023C, if any gift is given to them or even gift received by them, both are not covered under 56(2)(10). So if I am in giving any gift to the 1023C institution, it is exempt in their hands. If they are giving any gift to me, then it is exempt in my hands. You get my point? Similarly, section 12AA. 12AA means what, Kanna? Religious or charitable trust. So if I am giving any gift to religious or charitable trust, it is exempt in their hands. If they are giving me any gift, it is exempt in my hands. It is not taxable. Next, Delhi. So the last point is all the other cases as may be prescribed, and the act has prescribed one case. Okay. What is the case? Any immovable property received by a resident of unauthorized colony in Delhi. So if a immovable property is received by a resident living in an unauthorized colony in Delhi, then the immovable property received will not be taxable under section 56(2)(10). You get my point? So all these are exceptions. So for all these categories, now that we are going to discuss, okay, 56(2)(10), it is not applicable. It is not applicable, so be very careful. Now let's come to the core of the section, that is 56(2)(10). I already told you, when an asset is transferred from one person to another person, then the transferor will pay the capital gains on that particular asset. Correct? And the transferee, that is the person who is receiving the asset, will pay the tax under 56(2)(10). Okay, if it is not covered under salary and PGBP. This section, that is 56(2)(10), is applicable to all the assessees. All the assessees. Now we can divide this section into three categories. That is, first category is money, second category is immovable property, third category is movable property. First, let us talk about money. Okay, if money is received by a assessee, then aggregate of all the money received, if it crosses 50,000, then the entire amount is taxable. So if I am receiving a gift from my friend, okay, one friend gives me a gift of 30,000 rupees, another friend gives me a gift of 40,000 rupees. So total how much? 70,000. This entire 70,000, since it is crossing 50,000 limit, the entire amount of 70,000 is considered as income under income from other sources. You get my point? And it is taxable. You have to take the aggregate amount. during the year. Now let's talk about immovable property, which is nothing but land or building or both. Okay, so here also there can be two cases: immovable property received without consideration, immovable property received for inadequate consideration. So firstly let us discuss without consideration. If any immovable property is received without consideration, okay, for example my friend gifted me a house, okay, in such case, and I did not pay any money to my friend, in such case, if the stamp duty value of the house crosses rupees 50,000, then the stamp duty value is taxable under 56(2)(10). Okay, so if the stamp duty value per transaction, here we are not talking about aggregate karna, here we are talking about per transaction. If the stamp duty value per transaction crosses 50,000 rupees, then the stamp duty value is taxable under 56(2)(10). You get my point? Now let's come to inadequate consideration. For example, my friend has given me a house of rupees 1 crore, okay, but I paid him only 20 lakh rupees, which means I have given him inadequate consideration. In such case, what will happen? Firstly, step 1. Step 1 means what you have to do. 50,000 or 10% of the total consideration, whichever is higher, you have to find out. So in my example, how much is the total consideration? 1 crore. So 50,000 or 10% of 1 crore, that is 10 lakhs, whichever is higher. What is the higher amount? 10 lakh rupees. Correct? Then step 2. Step 2, you have to find stamp duty value minus consideration. Stamp duty value minus consideration. What is the stamp duty value? 1 crore. What is the consideration? 20 lakh rupees. So what is stamp duty value minus consideration? 80 lakhs. 80 lakhs, correct? Now, if the stamp duty value minus consideration is greater than the higher value that we calculated above, then stamp duty value minus consideration will be taxable under 56(2)(10). So, in my case, since 80 lakh rupees will be higher than 10 lakh rupees, 80 lakh rupees is taxable under 56(2)(10). Listen one more time, very important, and since there is an amendment, it is even more important, because earlier this used to be 5%, now it has come to 10%. So listen very carefully. Step 1, find 50,000 or 10% of the consideration paid, whichever is higher. Step number 2, if stamp duty value minus consideration is greater than the higher amount, then stamp duty value minus consideration is taxable under 56(2)(10). If stamp duty value minus consideration is not greater than the higher amount, then you need not pay any tax. Okay. And one more special point here: if the stamp duty value minus consideration is considered for taxation, then the stamp duty value will become the cost of the property for future sale. Okay, so in my example, okay, I am receiving a house whose stamp duty value is 1 crore from my friend. I am paying my friend 20 lakh rupees, correct? So now how much amount I should pay the tax on? Answer is 80 lakhs. Since 1 crore minus 20 lakhs, that is 80 lakhs I have to pay the tax. Now, since I have paid the tax on the stamp duty value of 1 crore, the stamp duty value of 1 crore will be the cost of my house. It will become the cost of my house for future sales. So in future, if I am selling my house, then while calculating the capital gain, the cost of acquisition should be taken as 1 crore. You get my point? I hope you are clear. You read the provision, okay, and be thorough with the provision. You will not make mistake. Now let's come to movable property. We discussed money, we discussed immovable property. Now let's come to movable property. In movable property, not all movable properties are covered in this section. Only certain movable properties are covered. What are the certain movable properties? JAD pass, BS. JAD pass we already discussed in capital gains chapter, correct? Jewelry, archaeological collection, drawing, painting, any other work of art and sculpture. Now here two more items are included: bullion and shares and security. Bullion and shares and security. So only if all these items are received without consideration or for inadequate consideration, only then 56(2)(10) will be coming into picture, else 56(2)(10) is not allowed. So Kanna, what will happen if I receive a car as a gift? My friend gave me a Mercedes car. So should I pay any tax? Answer is not required. My friend gifted me a laptop. Should I pay any tax? Answer is not required. You get my point? However, if my friend gifted me a painting, should I pay the tax? Answer is yes, it is covered under 56(2)(10). My friend gifted me some bullion or jewelry, should I pay the tax? Answer is yes. My friend gifted me some shares, should I pay the tax? Answer is yes. You get my point? Now here also there are two cases. The movable property can be received without consideration or it can be received for inadequate consideration. If it is received without consideration and if the aggregate FMV that is aggregate fair market value exceeds 50,000, then the aggregate fair market value is taxable. You get my point? For example, my one friend has given me shares worth 40,000 rupees. One more friend gave me jewelry worth 20,000 rupees. Share worth 40,000, jewelry worth 20,000. So totally how much? 60,000 rupees. Correct? So this entire 60,000 rupees is taxable under 56(2)(10). You get my point? You have to find out the aggregate amount. Now let's come to inadequate consideration. If it is received for inadequate consideration, you have to find the difference between the fair market value and consideration. If the difference between fair market value and a consideration aggregate exceeds 50,000, then the aggregate of the difference will be taxable. Aggregate of the difference will be taxable. It means what you have to do, you have to find fair market value minus consideration, and for each and every asset you have to find out like this. Then you have to add all of them together. If the total is more than 50,000, then the fair market value minus consideration is taxable under 56(2)(10). I hope you are able to understand the concept. So this was about the gift. Okay, and here also Kanna, uh, movable property I talked about, correct? Chat pass BS. So whenever you are receiving the movable property, that is jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion, shares or securities, if you are receiving them and if you have paid the tax under 56(2)(10), then the fair market value will be the cost of acquisition. Fair market value will become the cost of acquisition of those assets for future sales. Okay, hence if there is electric vehicle, car, phone, watch, furniture, etc., whatever it is, then there will not be any tax. Okay, now let's come to some special points. So firstly, we discussed about immovable property, correct? Now in that immovable property we should take the stamp duty value. The stamp duty value should be taken on what date? The registration date or agreement date? Answer is generally we should take the registration date. However, if as on the date of agreement, okay, so on or before the date of agreement, if any full or part of consideration is received via account pay check, account pay bank draft or electronic clearing system or any other prescribed mode, okay, then you have to take the agreement date. This is same as what we discussed in section 50C and section 43CA. The same provision is repeated here also. And similarly, in section 50C we had the assessee had the option to go to valuation officer, correct? Here also the assessee is having the option to go to the valuation officer. So if the assessee is not satisfied with the stamp duty value, he thinks that the stamp duty value is a very high amount, then he can request the assessing officer. The request assessing officer will transfer the case to valuation officer. Valuation officer will find out the value of the property. If the property value found out by the valuation officer is higher than the stamp duty value, then consider the stamp duty value itself. No need to take the higher value. If the value found out by valuation officer is lower than the stamp duty value, then assessee can take the benefit of the lower amount. You get my point? Now, section 56(2)(10) is applicable only if the asset received is a capital asset. So for example, if my friend is giving me a gift and if that gift I am going to include it in my stock, then I should not see section 56(2)(10), I should go to PGBP. Okay, only if the gift that my friend is giving, if it is a capital asset for me, then only I should see 56(2)(10). You get my point? Now next. This I already told you. The amount that is taxed under 56(2)(10) will be becoming the cost of acquisition of the asset. This I have also discussed in section 49 while discussing capital gain chapter. Okay, Kanna. Now let's come to the next section, that is section 56 to 7b, which is popularly called the angel tax. So what is this angel tax? When shares are issued at premium. So if any closely held company means what, Kanna? A company with a limited number of shareholders. So if there is any closely held company or unlisted company, okay, if such company issues the shares to a resident shareholder, okay, on premium. Premium means what? On amount more than the face value, correct? Then in such case, income from other sources will arise. What will be income from other sources? Income from other sources will be issue price minus fair market value. Issue price minus fair market value, not face value. Be very, very careful. Don't take issue price minus face value. Take issue price minus fair market value. I gave you an example also. So if the face value is rupees 10, okay, and the fair market value is 15 rupees, the shares are issued at 150 rupees. In such case, what you should do? We should take total issue price, that is 150, minus fair market value, that is 15 rupees. So total tax will be 135. Total amount of income will be 135. You get my point? Once again, I will repeat it very, very quickly. If there is any closely held company or unlisted company, okay, for example, a private limited company. So if a private limited company is issuing any shares to a resident shareholder for a premium, then income from other sources shall be issue price minus fair market value. Okay, be very, very careful. Now let's come to section 56 to 11, which is a comparatively new section which talks about compensation on termination of employment. Kanna, this compensation on termination of employment we have already discussed in salary chapter. However, in salary chapter, it is necessary to have the employer-employee relationship. Okay. However, what will happen if there is no employer-employee relationship? Answer is that it will be covered here in the income from other sources chapter. For example, if A is giving 1 crore rupees to B and he is asking B that you quit your job, okay, but he is not asking B to join him, he is just asking B to quit his job. So this is a compensation on termination of employment. However, between A and B there is no employer-employee relationship because A is not offering a job to B. Hence, this will be covered here, and the person who is receiving the money, that is B, has to pay the tax under income from other sources. You get my point? Now let's come to dividend. So of dividend has completely changed from this attempt onwards. So now what has happened? Section 1150, which talks about dividend distribution tax, has been scrapped. Okay, then section 1034, which talked about exemption on dividend income, that has been scrapped, and also 115 BBDA, which told that dividend in excess of 10 lakh rupees is taxed at 10%, that also has been scrapped. So now what is the new provision? The new provision is that whatever dividend is received by the assessee will be taxable under income from other sources normally. Like any other income, even dividend income is going to be taxable under the normal tax rates. Okay. However, one kutty special point. What is the special point? If a dividend is received after 1/4/2020, however, dividend distribution tax was paid in the previous year itself. Okay, that is a very special case where dividend distribution tax was already paid. In such case, that dividend will be exempt in the hands of shareholder. And if the dividend is more than 10 lakh rupees, the amount more than 10 lakh rupees will be taxable at 10%. Okay. On all the other dividend received from previous year 2021 onwards, it will be taxable normally under income from other sources. Okay. Now let's come to deemed dividend. So there are certain cases where there is no actual dividend, however the Income Tax Act deems that money to be the dividend income. Okay, to be dividend income. So first deemed dividend is section 2 clause 22 subclause A for asset, A for asset. So if any there is any distribution of assets to its shareholders, okay, so if any company is distributing assets to the shareholder, then the asset received by the shareholder will be deemed as dividend and it will be taxable under income from other sources, but only to the extent of accumulated profit, that is reserves and surplus, profit and loss account, etc., in the balance sheet, whether capitalized or not. So whether accumulated profit is capitalized or not capitalized, that should not be considered. The total accumulated profit, till that extent it is considered as deemed dividend. The amount above the accumulated profit will not be considered as deemed dividend. You get my point? Now let's come to section 2 clause 22 subclause B. B for bonus to preference shareholders. Bonus shares to preference shareholders. Now, and debentures, etc. So if there is any distribution of debenture stock, deposit certificate, debenture stock, deposit certificate to the shareholders, or if there is a distribution of bonus shares to the preference shareholders, not equity shareholders, only to the preference shareholders. In such case, this distribution, that is debenture stock, deposit certificate received, or in case of preference shareholders, the bonus shares that is received will be considered as deemed dividend in the hands of the shareholder to the extent of accumulated profit, whether capitalized or not extent. Okay. Now let's come to section 2 clause 22 subclause C, and C means close. C means close. Okay. We have already discussed this 222C while discussing about liquidation. Okay. So what will happen when a company is going into liquidation? The company will distribute its assets to the shareholders. Okay. So whatever asset is received by the shareholder on liquidation will be deemed as dividend to the extent of accumulated profits, whether capitalized or not. Okay. And they have to pay tax under income from other sources. Link with section 46 that we discussed in capital gain chapter. Now let's talk about section 2 clause 22 subclass D, and D means decrease. D means decrease. Okay. So if there is any distribution by a company to its shareholders by way of reduction of share capital, for example, okay, I am having shares of rupees 10 in a company. Now what does that company do? Company is telling that from now onwards we are reducing the share price from 10 rupees to 2 rupees, and we will give you the 8 rupees, and they are giving me the 8 rupees. In such case, this is called reduction of share capital, and the amount received on reduction of share capital is deemed dividend as per income tax law to the extent of accumulated profits, whether capitalized or not. Okay. Now let us talk about section 222E. 222E. Now, first special point. 222 A, B, C, D, all these four sections apply to all the companies. However, 222E is applicable only to closely held company or unlisted company. Closely held company or unlisted company, that is basically the company in which the public are not substantially interested. Company in which public are not substantially interested. Now, when is this section applicable? Let us see. So, if there is a shareholder, the shareholder is having 10% or more voting power in a company. If a shareholder is having 10% or more voting power in a company, and if that shareholder is receiving any loans or advances from the company, then this loans or advances received will be deemed as dividend under section 2 clause 22E. It does not matter whether there is interest on loan. It does not matter whether the loan is repaid or not. You need not see anything. If loan is received, it is deemed as dividend. And not only this, if the shareholder is having substantial interest in any concern, and if that concern is receiving loans or advances from the closely held company or unlisted company, then also the loan or advance will be considered as deemed dividend in the hands of shareholder. For example, I am Mr. P. Okay, I am having shares in PB Limited. I am having shares in PB Limited, which is a closely held company. Okay, now what is happening? If I receive loans or advances, then it is deemed dividend in my hands. Correct? Now, I am also a partner in a partnership firm called PQR. I am also a partner in a partnership firm called PQR and Company, where I am having 35% profit sharing ratio. Hence, I am having substantial interest. Correct? What is substantial interest? Substantial interest means 20% or more voting power or 20% or more profit sharing ratio at any time during the previous year. So if I am having 35% profit share, now this PB Private Limited is giving 1 lakh rupees as loan to this partnership firm. They are not giving to me, they are giving to the partnership firm. Still, that 1 lakh rupee will be taxable under income from other sources in my hands. Even though I am not receiving the loans or advance, still I have to pay the income tax on the loans or advance. Purida? Similarly, one more point. If there is any person who is getting the loans or advance from that company on my behalf or for my benefit, then also that loan or advance will be taxable as deemed dividend in the hands of shareholder. For example, that closely held company is giving a loan to my wife, okay, on my behalf, then the loan or advance received by my wife also will be taxable as deemed dividend in my hands. Okay, so I have to pay the tax under income from other sources. So let me repeat. If there is a closely held company or unlisted company, that is basically any company in which the public are not substantially interested, and if a shareholder is having 10% or more voting power in that company, then the loans or advances received by the company will be deemed as dividend under section 222E. If the company gives loans or advances to any concern na enna, company, AOP, BOI, firm enna vena irukkalam. If the closely held company or unlisted company gives loans or advances to any concern in which the shareholder is having substantial interest, then also the loans or advance will be deemed as dividend in the hands of the shareholder. Similarly, if the closely held company or unlisted company is giving a loan or advance to any person for the benefit of the shareholder or on behalf of the shareholder, then also such loan or advance will be considered as deemed dividend in the hands of shareholder. I hope you are clear. Now, and this loan or advance will be considered as deemed dividend only to the extent of accumulated profit which are capitalized. So in section A, B, C, D, okay, 222 A, B, C, D, it is given whether capitalized or not. However, in 222 E, it is considered as deemed dividend only till the extent of capitalized accumulated profit. So if it is not capitalized, don't consider it. Only till the extent of capitalized you have to take it as deemed dividend. Okay, next. Even if loan is repaid or interest is charged at market rate, then also it will not make any difference. Okay, now dividend stripping is not applicable for you. Bond washing is also not applicable for you. Now let us see exceptions to deemed dividend. Exceptions to deemed dividend. First and foremost, so there are five places where even though it might cover in above categories, that is 222 A, B, C, D or E, but still it will not be considered as deemed dividend. So what are those transactions? Number one, if any loan or advance is given in the ordinary course of business of money lending, where money lending is the substantial part of business. So for example, if I am the shareholder of a company and I am having more than 10% shares in the closely held company, the business of the closely held company itself is money lending. And in the ordinary course of business, if I am receiving any loan from that company, then it will not be considered as deemed dividend. Get my point? Next, any dividend paid by a company that is set off against the loan or advance deemed as dividend under 222E. I told you, right, in 222E, the loan or advance received will be deemed as dividend. Now, in future, the company is telling me, okay, since you have already paid the tax as dividend on this particular loan amount, you do one thing. You keep this loan with yourself and we will set off this loan against your dividend amount. We will set off this loan against your dividend amount. So what is the company doing? I got a loan from the company, correct? Now on this loan, I have paid the tax under 222E. In future, that company is giving dividend. And what they are telling, that you do not repay the loan back, you keep it and we will set off this loan against the dividend that is payable to you. In such case, when the loan is set off against the actual dividend, it will not be taxed once again. It will not be taxed once again. Hence, when dividend is paid by a company that is set off against the loan which was deemed as dividend under 222E, it is not going to be taxed again as dividend. You get my point? Next, buyback of shares will not be considered as deemed dividend. Number 4, if any shares are allotted to the shareholder of a demerged company by a resulting company in the course of demerger. I told you an example of Tanishq, that is demerging from Titan Limited. So when the shareholder of Titan Limited receives the new shares of the demerged company, that is Tanishq Limited, in such case it will not be considered as deemed dividend. Next, if any distribution covered under section 222C, that is liquidation, and 222D, that is distribution, that is decrease of share capital for preference shareholders. Okay, so section 222C and 222D only applies to equity shareholders. It does not apply to preference shareholders. You get my point? So this was all about dividend income. Very important. Read once again, you will be able to get more clarity. Section 10 clause 35 has been abolished now. Now that exemption is no more. Now firstly let us discuss about section 115 BB, which talks about casual income. So what is casual income? Winning from lottery, quad, crossword puzzles, horse race, card games, any other games of any sort, any form of gambling or betting. So winnings from all these places will be covered under section 115 BB. On this income, the assessee has to pay the tax at a flat rate of 30% plus health and education cess plus surcharge. 30% flat rate plus cess plus surcharge. No expenses allowed against this income. No allowances allowed against this income. No deduction is allowed under chapter 6A. No loss is allowed to be set off, that we learnt in set off or carry forward of losses, and even basic exemption limit cannot be adjusted even for resident individual and HUF. Okay, in section 111A, 112 and 112A that we studied in capital gain chapter, we discussed that resident individual and HUF will get the benefit to set off their basic exemption limit against such income. However, here, that is in section 115BB, even resident individual and HF do not get any benefit. For all the assessees, they have to compulsory pay a tax of 30% plus cess plus surcharge, as the case may be. So if I am receiving a lottery income of 2 lakh rupees and I am not having any other income during the previous year, so what is my total income? 2 lakhs. What is the basic exemption limit? 2,50,000. Can I adjust both? Answer is no. Even though my basic exemption limit is 2,50,000, I still have to pay the tax of 2 lakh into 30% plus 4% plus surcharge if there is any surcharge. You get my point? So section 115 BB, and link this section 115 BB with the TDS provision also while answering the questions in the exam. Now let's talk about rent. If a rent is covered under house property, then it is taxable in the house property chapter. If it is other than house property, that is rent on machinery, etc., in such case, if it is the business of the assessee, it is covered in PGBP. If it is not the business, it is covered in income from other sources. Similarly, we had discussed about composite income while studying in house property chapter. So in case of composite income, it is, if it is the business, it is taxable in PGBP. If it is not the business, it is taxable in income from other sources. And now let's talk about subletting. Subletting means what? I am getting a house or any property from some person, okay, and that property I am giving on rent to another person. So I am taking a house on rent and I am giving the same house on rent to another person. This is called subletting. Now, even though a house property has been given to a person on rent, still it is not covered under house property chapter, because in case of subletting, the assessee is not the owner of the property. Since the assessee is not the owner, subletting will be covered either under PGBP if it is that, if that is the business, or if it is not the business, it will be covered under income from other sources. You get my point? So that was about rent. Now let's talk about keyman insurance policy. I've already told you n number of times. So if keyman insurance policy proceeds are received by the employer, it is taxable under PGBP. If it is received by the employee, it is taxable under salary head of income. And if it is received by any other person, then it is taxable under income from other sources. Then directors receiving sitting fees from the board meetings, it is taxable under income from other sources. Okay. Then if any person who is not the employee of a organization, and from such organization if the person is receiving paper sitting, paper checking, seminar fees, okay, professor fees, etc., in such case it is taxable under income from other sources. So for example, I am a chartered accountant, okay, the CA institute, that is ICAI, is setting me as a paper checker for the CA examinations. So if I am a paper checker and if I am receiving any money from institute, then since the institute is not my employer, hence the money received from the institute will be taxable under income from other sources. Okay. Now let's talk about family pension. What is family pension? The pension received by the family members of the employee is called family pension. Generally, family pension is fully taxable. However, there is a deduction allowed for family pension. What is the deduction? Deduction is one third of family pension or 15,000 rupees per annum. 50,000 per annum, whichever is lower. So that is the family pension. However, we discussed in the exemption chapter under section 10 clause 18 that if there is a receipt of gallantry awards and their family is receiving family pension, then it is exempt. So you should link that point also. And I also told you a special point that if arrears of family pension is received, if arrears of family pension is received, then section 89 relief, that is in the salary chapter, it can be claimed for arrears of family pension also. Now let's talk about interest income. Usually interest income is fully taxable. However, if interest is received on compensation or enhanced compensation of compulsory acquisition, then a deduction is applicable available of 50 percentage. 50 percentage standard deduction is applicable. So if 1 lakh rupees is received as the interest, then 50,000 rupees I can claim it as deduction. Balance 50,000 is my income under IFOS. Okay. Now let's talk about section 10 clause 15, that is interest incomes that are exempt. Firstly, gold interest on gold deposit bond 1999 and deposit certificate under gold monetization scheme 2015. Okay. Interest received on such bonds is totally exempt from tax under 10 clause 15. We also discussed that these two bonds are exception to capital asset definition under 2 clause 14 that we discussed in capital gain chapter. So link both of them. Interest received on national plan certificate is exempt, capital investment bonds is exempt, relief bond of RBI exempt, interest paid to a non-resident by a IFSC, that is International Financial Service Center unit, is also exempt in the hands of non-resident. Then we already know that interest received on PPF, Sukanya Samriddhi Yojana, etc., etc., all are exempt from taxation. Then post office saving bank account interest is also exempt up to rupees 3,500 per annum or 7,000 in case of joint account. So this post office saving bank account, okay, the interest received, there is exemption also, and there is also deduction under section 80 TTA and 80 TTB. Now what you should do? Firstly, you claim the exemption. Then balance amount that is taxable. On this amount you can claim the deduction under 80 TTA or 80 TTB as the case may be. Now all the other interests are taxable normally, and since income from UTI mutual fund are no longer exempt, so they are also fully taxable. Now let's talk about deductions. Okay, deductions under income from other sources. Generally, if any income from other sources is taxable, then the expenses relating to such income will be allowed as deduction. Okay. However, if any income is exempt, then expenditure should be ignored. It will not be allowed. We have already discussed. Then we already discussed that interest on compensation or enhanced compensation of compulsory acquisition, you will get 50% deduction. Family pension we already discussed. One third of the family pension or 15,000 per annum, whichever is lower, is allowed as deduction. Then if there is winnings income under 115BB, no deduction is allowed. No deduction, no allowance, no loss is allowed, no basic exemption limit, and also no deduction under chapter 6A. So be very careful. Now this is an amendment, new point, so listen very carefully. So earlier dividend income and income from units of mutual fund etc. used to be exempt, but now they are taxable, correct? So when they are taxable, the expense relating to such income should also be allowed as deduction, correct? However, there is a limit on the expense that is allowed. What is the limit? Limit number 1, only interest expense is allowed as deduction. No other expense will be allowed as deduction against the dividend income or income from units of mutual fund under 1023D or specified company under 1035. Get my point? So only interest expense will be allowed, and also up to a maximum of 20% of such income. Maximum of 20% of such income. So for example, I am having shares in ABC Limited. I am having shares in ABC Limited and I received a dividend of 2 lakh rupees. For buying the shares of ABC Limited, I took a loan of 1 crore, and in that year I have paid the interest of 10 lakh rupees on such loan. Correct? So what is my income? 2 lakh rupees. What is my expense? 10 lakh rupees. Interest expense is how much? 10 lakh rupees. So what will be allowed as deduction? So dividend income is 2 lakhs. The deduction will be the total expenditure or 20% of the income, whichever is lower, that is 40,000 will be allowed as expense, and balance 1,60,000 will be treated as income under income from other sources. You get my point? I hope you are able to understand. Okay, then similar to PGBP, there are disallowances in income from other sources also. So if any payment is made to a resident without deducting TDS, 30% disallowed. To a non-resident, it is fully disallowed. Okay, excessive payment to related party or associates, the unreasonable amount is disallowed. Okay, then if payment is made about 10,000 rupees to a person in a day in any mode of payment other than account pay check, account pay bank draft, electronic clearing system or any other prescribed mode, that is also disallowed. Then deemed profit is applicable here also. So for example, if any bad debts related to income from other sources have been recovered, then it will be taxable under income from other sources, and personal expenses are not going to be allowed under income from other sources also. Then there are some other points. Salary received by MP MLA is not taxable under salary chapter, it is taxable under income from other sources, and you should be knowing that their daily allowance and constituency allowance is exempt. Okay. And also remember the point, this daily allowance, constituency allowance, it is not exempt if new tax regime under 115 BAC is chosen. Next, awards received are generally taxable. However, certain awards are exempt. For example, we learnt about the national awards, correct, for scientific, artistic, nature, etc. So all those awards are exempt. All the remaining awards are going to be taxable. Agricultural income received from outside India is very much taxable, and it is taxable under income from other sources. Next, royalty income is taxable under income from other sources. Advance money forfeited, if it is on or after 1/4/2014, then it is taxable under income from other sources. Okay, and remember very carefully, royalty income and dividend income, even if it is the main business of the assessee, still it will not be taxable under PGBP head of income, it will be taxable under IFOS. Okay, so don't make that mistake. So this was the revision for income from other sources chapter. I hope you are clear with the provisions under income from other sources. Keep learning, keep revising, solve as many questions as possible, and confidently go to the exams and rock over there. So see you in the next video. Till then, take care. Bye bye.